Have you ever heard the phrase, debt is the root of all evil? Debt is a kind of slavery, and this is true to a certain extent. Because when you're in debt, your life ends while you try to pay your debts. They don't wait for you, and they grow day by day since nobody lends money for free, and there's always interest. Despite all this, the United States, the most important country in the world, sees a total U.S. consumer debt of almost $15 trillion, which raises the average household debt to more than $5,300. The U.S. GDP is a little over $21 trillion, meaning almost the entire economy is based on debt. But I have good news. Debt isn't always negative. This is an unpopular opinion because most of the debt we have is bad debt. You probably also have credit card debt, a car loan, and maybe student loan debt, and you're thinking it will take you decades to pay off all these debts. So how the heck can it be a good thing? To understand how it can be positive, let's look at how rich people manage to use debt to make even more money. In fact, it may seem a little complicated and strange because someone with a lot of money theoretically shouldn't go into debt. In fact, people who don't have money should go into debt, but that's not how it is. How does capitalism work? In this video, we'll find out how rich people use debt to make even more money. So like the video, and now we'll see 5 ways rich people make money through debt. Let's start with number 1. Most commerce is based on this. It may seem a little controversial because borrowing money to start a business is a horrible idea, and I personally would never do it. But there are businesses, especially traditional ones, where using debt is the best option. Let's say you want to sell pens. It's a very common product and there's almost always demand. Ideally, you'd fly to China to find a factory that produces the type of pen you're interested in, with good quality and at the right price. You buy a container of pens to ship them to the United States and distribute them to your customers. But this, to date, is mainly done online through websites like, unless it's a more particular product where you have to fly to the factory to follow the production. But here's the interesting thing. You don't have to pay for the products first to get them. Let me explain. In the last 50 years, China has become the world's factory, producing literally everything in the Silk Country. There are thousands of factories working tirelessly to produce everything the world needs. To facilitate sales, most of these factories would be happy to sell their products, letting you pay them in the future. Of course, this type of loan isn't granted to strangers, so you'll have to build some kind of trust with them. But this is how business has been handled for the last 50 years. Once the customer sold the product in the United States or anywhere else in the world, they could pay the Chinese factory. Basically, it's about borrowing the products, helping the factory sell them, adding something above the price to generate profit. What makes this strategy excellent is that you're not using your money in this transaction. That's why sales is one of the greatest skills you can master. Number 2, refinancing real estate debt. This is the best kind of debt because it's full of loopholes. If you don't have a mortgage, then you have to pay extra taxes. Rich people always have more than one mortgages to get all the possible deductions. Remember, every dollar you should pay in taxes that you save instead is one more dollar earned. So this is another way the rich get richer. But let me give you a more practical explanation. This is how rich people basically get richer through properties. Let's say you've saved $200,000. Yes, it's a lot of money for normal people, but if we're honest, this is peanuts for the rich. You can't even buy a house with that. You couldn't get an $800,000 mortgage, since you need to pay a down payment of at least 20%. But here's the secret. Suppose you find a property that costs $500,000 and is in bad condition. It needs a lot of restructuring. Go to the bank and secure a mortgage with a 20% down payment. Let's assume you'll spend around 10% of the house's total cost on renovations, approximately $50,000. Once the renovations are complete, return to the bank, but this time to refinance the mortgage. When you obtained the initial mortgage, the property was valued at only $500,000 because it was in poor condition and undesirable. However, after remodeling, the property has become more attractive, and people are now interested in renting it. This raises the market value to $700,000. Now, just like before, you'll take out a mortgage for 80% of the new value, but 80% of $700,000 is $560,000. Out of this, $400,000 will go to pay off the original mortgage, and another $50,000 will cover the cost of the renovations. This leaves you with an extra profit of $110,000. You earned $110,000 using that, and ended up with a property that you rent out to accumulate capital and generate passive income. Plus, you'll avoid paying taxes because you have a mortgage. This is a very common practice among real estate investors. After explaining this, you can still say that debt is bad. I leave the answer in the comments section below. Number 3, hedge funds. Hedge funds are created by the rich for the rich to enrich the richest people, and they generally use unpopular methods and strategies. Ordinary people like you and me do everything possible to predict which companies will grow and increase their value to invest the money we earn working hard. But hedge funds often use the opposite strategy. They try to make money when companies fall or fail, as in the case of GameStop. Although in this case, the internet challenged the hedge funds and caused them to lose more than $13 billion. But how do these hedge funds work? These hedge funds make money with debt. Let's say, for example, that a certain stock is expected to fall, like Facebook, because you know that Apple, which produces the world's most popular smartphone, will announce next week that it won't allow apps to track your online activity like Facebook or Instagram do. This would considerably damage the business model of Mark Zuckerberg's app. At this point, grab your phone and call your broker to borrow a single share of Facebook, which costs, let's say, $100, and sell it immediately on the open market for $100. Congratulations, you now have $100 in your pocket, but you still owe your broker a share. Let's say you're right, and the following week the price of Facebook shares falls to $70. Use those $100 to buy one at $70 since the price has fallen. You can return it to the broker and collect the difference. Congratulations, you've earned $30. Sounds simple in theory, but what if the price it doubles overnight? Still, you must return that individual Facebook share to your broker and pay interest for borrowing it. Now you have to buy those shares for $200 to return them to the broker. When you buy a share and try to sell it, when it goes up, the maximum you can lose is the amount invested, except in the case of shorting. If the price keeps going up, losses keep increasing. Theoretically, you can suffer unlimited losses since, theoretically, the share price can go up to infinity. But if you have hundreds of analysts working for you, you can make a fortune using this strategy. Number 4, Forex or the foreign exchange market. This is how Forex works, a market where currencies are traded. It makes international commerce possible because it allows using the dollar in China. For example, if you have to buy Chinese yen to pay your employees. So it's a market where any person, any company can enter and buy foreign currencies based on various factors. These currencies fluctuate. For example, the Fed increases interest rates, which will limit the supply of dollars in the market and make the dollar stronger against other currencies, or vice versa. So if you can predict which currencies will go up or down, you can make a lot of money in this market. But what makes these markets so different from the rest? The reason is that for every dollar you use to trade in Forex, you can borrow another $100. This means that if you trade with thousands of dollars, you can hold a position of $100,000. If you end up getting a small profit, like 1%, it will be a huge value anyway. Number 5, the line of credit. It's a powerful tool. Every successful commercial company or entrepreneur uses it in several ways, especially if you have a proven business model. Borrowing money to finance purchase orders is practiced by practically all companies, so stop thinking all this is negative. Of course, debts with a high interest rate, like credit card debts, are horrible. But to get a lower interest rate, you must minimize the risks of borrowing money. How is that done? You build a path to becoming a reliable borrower. There are billions, if not trillions, of dollars in banks waiting for someone to borrow them. And even if there's no money, banks can create money out of nothing. If you liked this video, be sure to like it, and if you're new here, subscribe to the channel and activate notifications.